Welcome to Market Catalyst. I'm Julie Hyman, and here's what we're watching today. First up, Nike shares slump as the retailer's turnaround stalls. We'll break down the hurdles facing its growth. Plus, we'll bring you the annual crypto crime report as North Korean hackers see their biggest year yet stealing cryptocurrencies. And heading into the new year, we'll bring you 3 things investors have to get right in 2026. First up, let's take a look at the major averages here on this Friday. We are seeing a little bit of a lift from the major averages. The NASDAQ gaining the most, leading by up 1.2%. We've got the S&P up about 0.9%, and the Dow higher by almost 300 points, about 0.6%. We also just got the final read on consumer confidence, consumer sentiment from the University of Michigan here. We got the initial read earlier in the month, and it's coming in worse than expected and worse than that initial read, 52.9. The first read was 53.3. The estimate from economists was 53.5. So coming in a little weaker than expected. So we'll keep an eye on that and dig into it a little bit later with somebody from the University of Michigan on kind of what were the factors that were feeding into that. Let's talk about Nike because it is sinking after issuing disappointing third quarter guidance as weakness in China and Converse continue to weigh on the retailer. Still, it did top second quarter expectations. It's making some progress on its turnaround in North America. Joining me now, Tom Nikic is Needham & Company Managing Director of Equity Research. So, Tom, people here at Yahoo, I don't know if you heard the last half hour, but people are kind of fired up about Nike and that it's not necessarily making progress quickly enough. When do you think, or maybe today's a little bit of an indication, when do you think investors are going to lose patience here?
Yeah, look, I think clearly the turnaround is taking longer than people thought. I think that the new regime under CEO Elliott Hill is doing the right things for the brand long term. But I think what we've kind of learned is that some of the issues that were plaguing the company before Elliott came aboard, that maybe they were deeper rooted than people thought, which means it's going to be a lengthier turnaround than people thought. And so, I think investors do have patience, especially with a name and a brand as strong as Nike. But patience is not infinite. So I think they're going to have to start showing some progress, sooner rather than later.
Okay, and where is that need most acute? Do you think, is North America showing better signs than China? I know a lot of people pointing the finger at China this quarter. What do they need to do there?
Yeah, so China was clearly the biggest pressure point in the quarter. Very, very challenging market. The macro environment's tough. And I think, some of the issues that Nike had over the last 5 years, opened the door to some of the local players out there, such as Anta and Li Ning. So the competitive environment is tough. The promotional environment is tough. They also, I think in China, they went too far in terms of being a fashion brand. And really what's resonating now is, performance products and sports products. And unfortunately, Nike kind of swung too far in the opposite direction.
Okay, it's so interesting to me because you and most of the analyst community is still pretty confident that they can get this done. Do we just need to adjust expectations on the timeline? Or, how are you thinking any differently after this quarter?
I think it's more a function of the timeline for the recovery rather than the credibility of the recovery itself. There are some positive indications when you kind of dig into the numbers. So, for example, they've talked about having a bigger focus on sport and performance categories, and those categories are actually doing quite well. They talked about their running business being up 20%, and they talked about training and performance basketball doing quite well. So those initiatives are taking hold, but when simultaneously you've got a $550 million year-over-year reduction in your retro business, it kind of offsets the positive indications that you're seeing elsewhere. And so they've spent now 2 years working down their retro classic business. My guess would be that we're starting to get towards the end of that headwind. And so if that headwind starts to taper off while you start to get better results from some of the newer styles, eventually you could see that switch flip.
Um, just sort of anecdotally, in talking again to some of the folks here who go into a Nike or go to the website, a lot of the changes that are happening at Nike seem to be, behind the scenes. How much of it is visible to the normal shopper there? Are they going into a store or going on the website and seeing things that are getting them excited and getting them want to shop there?
Yeah, look, product innovation and product development is one of the biggest needs for Nike at the moment. And, when you look at the prior regime, they were so singularly focused on channels of distribution and where they were selling things, they kind of lost focus of what they were selling. And so they plugged the gap with, okay, well, yeah, we could just sell more Jordans and we could sell more Dunks or we could sell more Air Force Ones. And, they kind of tried to just, kind of plug the gaps with those classic retro styles. Elliott Hill recognizes the importance of product innovation and new product development. And we are seeing, some of it, trickle in. And, there's been innovation in running, which has helped the revival of that category. But it's an industry that has really, really long lead times. I mean, from the time an idea pops into a, designer's head till it's actually in the consumer's hands, can be anywhere from, 12 to 18 months, if not longer. So that part, it takes time, and you are starting to see some of it come through, but it's gonna take some time to build.
We were just showing some footage of Skims. How is that? I mean, that is something that is a buzzier brand, or at least it was, that that Nike was partnering with. What is that doing for them at this point?
Yeah, look, obviously it's a very compelling, collaboration. It's a great brand, great product. And the other thing that it does is, for all the time that I've been covering this sector, people have talked about how the big athletic brands have neglected the female athlete. And I think you've kind of seen Nike try to address that more and more. You've seen it even excluding the Skims partnership. You've seen them have, some compelling shoes around WNBA players. And so having this collaboration with a brand that really focuses on women can help them address that that blind spot in their business that's been kind of a problem area for a very, very, very long time.
Okay, Tom, thanks so much. We'll keep watching it, see how it does in 2026. Appreciate it.
Thank you, Julie.
Coming up, over $3 billion in crypto was stolen over the course of this year. We'll break down where the risks are and where they might be next year after the break. Over $3.4 billion in cryptocurrency were stolen over the course of 2025 from January through early December. My next guest analyzed those thefts and found where the biggest risks lie and some of the progress made from a year ago. Jonathan Levin, Chainalysis CEO, is with me now. Jonathan, it's good to see you. You guys do this report annually, and it's always really interesting to see what happened in the crypto world because there do tend to be these hacks. So the total figure is $3.4 billion in 2025. How does that compare with prior years, and what do we need to know about that total aggregate number?
The total aggregate number is actually fairly consistent across the years. So last year was actually a very similar amount of money stolen. But there are some trends inside the total figure that I think are worth pointing out. If you look at the amount of money stolen by DPRK, by North Korea, that is actually up significantly year over year to 2 billion out of that 3.4 billion, which represents a real risk for the national security community. And really, it relates to nation state level actors getting access to cryptocurrency at a level that is concerning for governments around the world.
And Why is North Korea getting better at doing it in some way? If so, how are they getting better at doing that? Like, what do you attribute that big increase there in particular?
Their level of sophistication across their operation is actually increasing. And I would say that, we break that down into two elements. One is getting hands on the funds in the first place, and the second is the laundering procedure that they follow afterwards. In terms of them getting their hands on funds, they are infiltrating organizations with, tech workers. People may have heard of, the North Korean IT worker that has been given a job at a tech company that then is, infiltrating, stealing source code, getting access to different systems that then get leveraged for, these types of attacks moving forward. They've also increased that level of sophistication where they are now not just posing as an IT worker, but they are also posing as recruiters, talking to IT workers to gain access to their systems, to gain intelligence about how things are operating, to commit these types of attacks. So in terms of getting their hands on their crypto, that infrastructure around the IT worker, around infiltrating big organizations, they have become much more sophisticated at doing that. And it's a major threat that the industry is really tackling head on. And then the process of laundering those proceeds, they have increasingly become the most sophisticated money launderers in the game too. And so we have observed them breaking down the amount that they have been stealing into very small chunks and following, a pretty sophisticated integration and layering program to obfuscate those funds being reintegrated into the financial system and ultimately being used to pay for, the war machine and nuclear weapons.
Jonathan, it's really interesting on the front end of that, not the money laundering, but when they're doing the infiltration, that it's not technological so much as it is human, right? Like people actually going in and doing that work, which is frankly surprising to me. So how then do you defend against that? Is it a matter of better background checks? Like how does that work?
A lot of businesses that are at risk are doing in-person interviews, for example, for critical roles. There's a lot of provisioning of systems where you don't allow people to get access to sensitive systems, and you only get that to happen over time. There's a lot of technology that also gets used now in even remote interviews where you can really verify where someone is and find ways to detect different things happening on the computer itself. And really this is a cat and mouse game as the attackers get more sophisticated, and the defenders in the HR teams now need to really be consciously protecting the organization, not just bringing talent in to the company.
Jonathan, how much of the hacking that's happening or the thefts that are happening are hacking of systems like that, exchanges, and how much of them are infiltration of individual wallets? And for the individuals, how do people better protect against that?
Yeah, so actually we saw the largest increase in unique victims and the largest increase in number of incidents on personal wallets as well. And so this is something that I think is really important for people who are engaging in cryptocurrency activity. And cryptocurrency activity is just shifting into the mainstream. And so we will continue to experience this as more and more personal wallets are created. So I think that one bit of context here that's important for the viewers is that this is going to be the case as there is just a lot more regular payments and use cases for personal wallets across the internet. And so this is something that is going to continue to increase. We're working a lot with the wallet providers to actually secure and protect against these types of attacks as well. So there is a way where personal wallets are becoming actually a lot better at detecting these types of hacks, but it is difficult to protect an individual user where you need to really provide the security for their activity on the blockchain, and each individual can't be a cybersecurity expert. But if you look at the total value stolen, we're still 80% on the larger services compared to 20%, which is being stolen from personal wallets.
Gotcha. How much is AI playing into all of this on both sides, Jonathan? I mean, I've definitely seen that some of the recent hacks were powered by more sophisticated AI models getting into these wallets. But I imagine there's also defense that's powered by AI too.
Yeah, the place that I think AI plays a larger role than in the hacks side of this threat is actually on the scam side. And so really, if you think about the way in which people can lose money, you can either steal it from them or you can trick them into sending it to you. And actually AI is much better at tricking people into sending money to scammers. And those scammers can be very large organized crime groups too. But effectively AI impersonation, AI, making believable statements and giving someone the ability to translate into multiple different languages and approach victims anywhere in the world, that's something that AI is actually supercharging at the moment. And the only defense mechanism for that is to actually meet that with AI from the defending side. And so Chainalysis, we deploy AI agents at scale to actually collect intelligence from scammers that are attacking our population with the power of AI. And so you have this battle between an AI that can impersonate a victim and AI that can actually cause a victim harm. And that threat intelligence is being used across the industry to protect users against this type of scam activity. And very proud of the work that we've been doing over the past year for protecting consumers at scale globally against these types of threats.
Jonathan, good to see you. Thanks so much.
Thanks so much.
Coming up, TikTok is taking a big step to avoid a ban in the US. Find out what's next for the social media app. Stay tuned. You're watching Market Catalysts. TikTok owner ByteDance signing a deal to spin off its U.S. business that will make the U.S. version of the social media app majority owned by American investors. Tech editor Dan Howley joins me now with more on this deal. It feels a little anticlimactic, doesn't it, Dan? We've been talking about this for so long now. So this finally closed. What does it mean?
Yeah, they still have to go through all the proper regulatory agreements and channels. But yeah, I mean, the long saga of whether or not you'll still be able to use the app that keeps you from sleeping at night is coming to a close. This new entity will be, as you said, majority owned by U.S. investors. That includes Oracle, Silver Lake, and United Arab Emirates-based MGX. Now, as well as other investors, they'll get about 50% of this new organization. Existing investors will get about 30%, and then ByteDance will get a little less than 20%, and that kind of jives with the law that was originally passed to ban the app unless it divested. It's expected to close in January. The new organization will be in charge of retraining the algorithm on U.S. user data so that there's no outside manipulation. But ByteDance would still run the e-commerce side of things. And so, it's definitely appears that this deal is about to close. Now, this was originally started by President Trump back in 2020. There was all this talk about whether or not TikTok was a national security threat. They had senators on board. A law came forward. Joe Biden signed it into a law. And then President Trump got a lot of play on TikTok going into the election. And I guess he figured, well, it's not so bad after all. And so he then flipped and said we should just keep this going. So despite the fact that the law was signed, he kept signing executive order after executive order after executive order, holding off the enforcement of the law. ByteDance tried to challenge it. They lost at the Supreme Court. And so now here we are after the last delay. It appears as though an agreement is imminent. As I said, it should close in January. And then I guess, TikTok will be here. I mean, It does feel, as you said, anticlimactic, but it is just one of those things where, I think we just all knew that the writing was on the wall, that something was going to happen. Either that or Trump was going to leave office having signed 8 million extensions to keep the app going and then figure out what happens after.
Well, I was just going to say Oracle shareholders seem reassured that this finally is happening, right? Because we're seeing that stock up today. But of course, as we know, it's down a lot from its highs. But that's being seen as a positive for that company. But Dan, I wanted to ask you, okay, so the U.S. is going to use U.S. user data to fuel the algorithm now, but is it the same algorithm that they use in China? Because they wouldn't share the full algorithm, or how did that whole debate end? In other words, I guess what I'm asking is, like, is TikTok in the U.S. going to change at all for users as a result of all of that?
That's unclear. If you retrain the algorithm, how different is it going to be? Just quickly on the Oracle front, they've been a part of this for quite some time. They had Project Texas, where user data for the US was supposed to be stored on Oracle servers in the US, and so kind of separating them, but that wasn't enough. So, now, of course, they're going to be a major investor. So that's just an aside. But as far as the algorithm goes, if you're going to retrain it, it kind of remains to be seen if it's still going to have that, secret sauce that gets people to stay hooked. The reason why people just continuously scroll and scroll and scroll and scroll, depending on who you ask. If it's not as effective, that could be a good thing. But obviously, this new entity would say that it wouldn't be. And so, really, it'll come down to what that looks like and whether or not users notice any reasonable difference. And if they do, look, there's been backlash to social media before where people have said they were going to leave. Instagram had something along those lines years ago when one of the Jenners said that they didn't like a certain change and they were going to bounce. I think it really does come down to whether or not this training with the U.S. data is effective enough to, I guess, at least partially mimic what they have now.
We will find out. Well, I won't because I'm not on there, but I'm sure you will, Dan.
Canceled it too. I'm not. I can't. I gotta get.
We better use it for our time, maybe. I hope. I don't know. All right. Thanks, Dan. Appreciate it. Consumer sentiment data coming in worse than expected today. The final read on December consumer sentiment from the University of Michigan actually came in lower than the prior read and below where Wall Street had forecast those numbers. Joining us now, Joanne Shu, University of Michigan Director for the Surveys of Consumers. Joanne, good to see you. So when you get a read, you guys revise this number every month. You come out with the preliminary and then the final. When you see this kind of a change over the course of the month, why does that usually happen?
In the case of December, the change was very, very minor. At both the preliminary read and the final read that we released today, we saw very, very modest improvements from November that weren't actually outside the margin of error. So it's essentially a no change reading. We have some aspects of the economy where consumers reported some small improvements. We have a slight improvement in labor market expectations, some improvements in business conditions. But by and large, consumers, even though they think we're a little bit better off than November, they still think we are much worse off than we were at the beginning of the year.
And to that point, Joanne, I'm struck as I was looking at your final results for December, just to take a step back here. Okay, so the number in December, 52.9. A year ago at this time, we were at 74. That is just a remarkable deterioration in sentiment over the course of 12 months, is it not? I mean, how often do we see that kind of a drop in that period of time?
This is a very, very substantial decline over a relatively short period of time. Consumers are loud and clear that they believe that the outlook for the economy has soured quite a bit since the beginning of the year. A large part of this is because of the confusion and uncertainty that stemmed from tariff policy. In May and June, we had over about two-thirds of consumers spontaneously mentioning tariffs at some point during the interview. And that led to the development with tariffs led to a lot of worries that inflation was going to come surging back and it was going to throw the economy into chaos. In the middle of the year, consumers were by and large expecting a worst case scenario, something really catastrophic. Of course, we see that has not come to fruition at this time. And that has accounted for, some improvement in sentiment since then. However, consumers don't think we're out of the woods yet. Even though their inflation expectations have come down for 4 straight months now, I think, for the short run inflation expectations, we're still their inflation expectations still are higher than they were in 2024. So consumers just don't think we're out of the woods yet.
I thought that was so interesting, Joanne, that point that you just made, that inflation expectations have come down, but people still say high prices are one of the main reasons, if not the main reason, that they still don't feel better about their finances. So how do we kind of think about that? Is it just because the absolute level of prices is so much higher than it was, say, 5 years ago?
So we are following the share of consumers when we ask them about their personal finances. We ask them, what factors are driving their personal finances, and we have 47% of consumers providing unsolicited comments that high prices are providing strain on their personal finances, that their living conditions are eroded by high prices. And so, even though consumers have absolutely recognized that the risk of inflation in the future has softened, they remain very, very frustrated by the persistence of high prices. And when it comes to their pocketbooks, the stress that they're seeing is what they are paying right now, and not necessarily that price level relative to some point in time in the past or some point in time in the future. So consumers are able to distinguish between inflation and price levels, but it's really the price level that really makes them unhappy about their personal finances and the economy right now.
And Joanne, what about the divide between higher and lower income folks? How is that showing up in the survey?
We typically see an income gradient. So higher income people tend to have more favorable levels of sentiment than lower income people. In December, we actually saw a larger improvement among lower income folks, and higher income folks were little changed. But even with that sort of difference in December, we're still seeing, income being a major driver of sentiment differences and wealth as well. When we look at difference in sentiment by wealth, the consumers with the largest stock portfolios, their sentiment improved quite a bit over in the third quarter of this year after the tariffs started to calm down, whereas people who don't own stocks, their sentiment continued to decline. So stock values, as we know, are quite strong, but it really only supports the sentiment of the people who hold those assets.
Yeah, that makes sense and certainly matches up with what we've heard and talked to a lot of investors about. And finally, Joanne, I'm also curious about the political divide. I believe you guys survey, right, for political party and how sentiment aligns. Are we seeing anything notable, any notable changes or anything there?
This month we basically saw the same thing across all three political groups: Democrats, Republicans, as well as independents. As is usually the case, as we've seen going back to at least the Reagan administration, people who belong to the party that's in the White House tend to have more favorable levels of sentiment than people who don't. And independents are right in the middle. Independents are exactly where the national average is. And all three groups are in agreement that their views of the economy have declined a bit over the last few months. And all three are showing pretty much the same thing relative to November, not a lot of change.
Interesting. Joanne, thank you so much for the perspective on the report. It's helpful. Thank you.
Thank you.
Coming up, the next era of investing, how new AI tools are changing the landscape for retail investors. You're watching Market Catalyst. Robinhood is leaning further into its prediction markets and AI innovations for retail traders. Yahoo Finance's Josh Lipton spoke to Steve Quirk, Robinhood Chief Brokerage Officer.
Steve, always great to see you. So let's start with the news, Steve. You're rolling out these new prediction markets this week. Tell us about that, Steve. Walk us through it and why announce this now?
Sure. Yeah, so maybe I'll start off by just talking about how we got to this point with respect to prediction markets. The genesis or the starting point for us was last year's election. And we rolled those out probably the week before the election and saw just unbelievable pickup, not only from people viewing them to determine who the winner might be and how that might impact their portfolio, but people participating, almost 500 million contracts traded. And from there, we sort of expanded the offering from a couple different categories like economic indicators, rates going to go up, rates going to go down, cultural indicators, sports, and it's just expanded since then. And we're just continuing to improve on the experience for customers and deliver more of what they're looking for.
And Steve, listen, You have competition here. There's a number of companies, as you well
Yes.
know, that are playing down the prediction markets. I'm curious what you think, your company brings to the table that's different, Steve. What's the edge?
Yeah, it's a good question. But for starters, we sit with almost 27 million customers, and being able to do this all in one place is really important for people. So, you can basically use the information, even if you're not trading these, you can look at that information and help it determine, what I might want to do from an equity standpoint, from an option standpoint, from a crypto standpoint, or with my portfolio writ large. Is our interest rates going to move? Who's the next Fed official? All these things that will have an impact on portfolios are now right in front of you. And this information, as I think has been pretty illustrated pretty well, it's pretty accurate when there's dollars behind it. And so there's opportunities for people to use it as a direct hedge or to use it as something that complements everything else they're doing.
Steve, more broadly, I always love having you on because you have such unique line of sight into the retail investors and what they're doing with their money, Steve. November trading volumes they're interesting, Steve, for you all. It looks like equity and options volumes, if I'm reading this right, they were up year over year, but they were down month over month. Then it looks like crypto, Steve, it looks down both ways. How should we be interpreting this?
I would look at it in the context of the whole year. If you look at it in the context of the whole year, the months prior to that were some of the all-time high months in our history. So I wouldn't look at it as a real slowdown. I would look at it as more what I'd call a little bit more of a return to norm, even from this year. But even what we're seeing today, and by the way, I think there's a lot of hope that this is the start of the Santa Claus rally, which typically happens mid-December. We've been 4 days down, so I think people have been waiting for this. I think you're seeing people that are still pretty engaged. They're wrapping up the year and kind of rounding out the portfolio and making sure that everything is in order for the new year.
In terms of specific names, Steve, always curious to hear. What are you seeing? What are some of the more popular, commonly held stocks?
It's funny. There's a lot of rotation that happens. People are their own portfolio managers. But what we've seen recently is they've rolled out of names that have had some appreciation, like Rivian, and rolled back to the Mag 7, which for a while kind of fell out of favor, but now it's back in favor. So, this rotation is something that's really fun to watch. And as we watch customers typically take gains and sort of rotate into ones that they think have opportunities for appreciation.
Another stat that jumped out, Steve, margin balances, I see here, they were up about 150% year over year. What do you make of that? Is that, to you, Steve, do you see that, okay, that's a sign of confidence, risk appetite? What's your read?
I think it's really a factor of two things. Number one, we've been growing our margin business. So a lot of that is just net growth of that business, attracting new customers who are utilizing margin. And then the second component of it is, again, with elevated trading and elevated interest in the market, you're naturally going to see those margin balances go up. But you're right, the increase has been pretty extreme.
Net deposits, about $7 billion in November, Steve. That represents 25% annualized growth rate relative to October. Is that new customer growth? Is that existing users consolidating assets? What is that, Steve?
Yeah, it's a combination of both. New customers and existing customers putting money to work. Our customers are quite young. Average age is early 30s, and they're in a capital appreciation phase of their life. So they put money to work through thick and thin, which they should at that age. And we see that through deposits and the activity.
Finally, I'll get you out of this, Steve. Listen, New Year's here, 2026. What are some of the big trends, the big themes, Steve, you're going to be on the lookout for?
Well, I think, the prediction markets are still such a hot space with everything that's coming, and there's so much more room to grow in that space. So we'll have a focus there. But we also have a focus across a variety of other areas, including AI and technology advances in both the stocks that people are trading and the things that we're rolling out.
Steve, always great to see you. Thank you.
Thanks for having me.
Coming up, we'll talk to the CEO of a startup that uses AI and wealth management about the 3 things investors have to get right in 2026. Stay tuned. You're watching Market Catalysts. 2026 is just around the corner, and investors are positioning for growth. But our next guest says there are 3 things investors must get right to benefit the most in the new year. Joining us now, Brad Genser, co-founder of Farther, for this week's FA Corner, brought to you by Capital Group. Farther is a financial advisory firm that combines both expert advice with proprietary technology for its wealth management. We're going to talk more about Farther in a second, but I do want to dive right into your predictions, because I think this is really interesting here, because everybody wants to know what to get right or what not to get wrong when they're looking at their, potential biggest mistakes. So what do you think is the biggest mistake that people need to avoid next year?
Well, we are a wealth advisory firm. We always tell our clients, invest for the long term and don't stay emotional. Right now, there's a lot of things going on with how people are feeling about the economy, with how people are feeling about AI. And there's a lot of kind of uncertainty out there, but staying calm and investing for the long term is kind of the key thing that we advise for our clients.
So if I'm thinking about AI and sort of paying attention to, is it a bubble, is it not a bubble? What sort of pitfalls can that, if I'm focusing on that in the near term, what kind of pitfalls can that create if I'm thinking in that way?
So I think that the big question, of course, is, are we in an AI bubble? But I think, our position is, we're not. I mean, this is a place where real demand is, and what I monitor really, both as I think about planning for a business where AI is very, very central to what we do, as well as looking out on how to advise clients. It's really, I'm looking at like token growth and consumption of AI, and I'm also watching the price of the consumption or the price of tokens. Right now, like, we're net booming, and more demand is coming online. This year was the year the models got good enough, and a lot of people were pre-predicting the year of the agent. But agents are beginning to consume AI too, and we can see continued demand for it.
And do people need to, how do people then need to think about investing in the theme?
Sure, and I think that just like regular public markets or any markets, we really think about diversifying and investing in the broad theme. There's still idiosyncratic risk out there. Companies are going to make mistakes in how they finance. Companies are still getting up and bootstrapped, and a lot of them are very new. Even the big AI companies, only a few years old. They're not that mature on the business operating side of things. So it's really important to eliminate that idiosyncratic risk by investing in a diversified way. Also, when we think about diversification, we think about diversifying across the kind of capital formation stack. So one of the big themes for us at Farther is access to alternatives. So to access a lot of the growth opportunities in AI, you are going to have to go to private markets, because that's where all of the innovation is happening. We provide access to our clients to do that, and so we think about diversifying in public markets. We think about diversifying across the AI value chain, not just in the core companies, and we think about diversifying across companies as well.
So when you're thinking about investing in the private markets, what do investors need to know? Because frequently those private investments, or at least sometimes those private investments, can come with fees, for example. Sure. So how do you weigh all of that? In
a broad-based sense, AI is probably it is the fastest growing kind of thing we've ever seen in human history. Google revealed earlier this year that they were processing a quadrillion tokens. I had to look up what else is a quadrillion. It's like the number of ants on Earth is a quadrillion. So we don't even really, we've never seen anything that's growth like that in consumption. So I'd say I wouldn't be too worried about the fees, but going through at wealth advisors, they have better access, can control the fees, and that's something that we actually very much do at Farther. We go out, we find the good deals, we balance the fees versus the growth.
And the last thing that you guys are thinking about for next year, I'm just going to read it and then you can tell me what it means. You say, in a strong market, after-tax outcomes become the real differentiator. So in other words, you have to do well enough that you make up for whatever you're going to have to pay out in capital gains, I guess is what you mean.
That's right. I mean, as an investor, as a private investor, what we care about is what we take home. Companies care about that. Foundations care about that too, but foundations have don't pay taxes at the same rate that we do. So being sensitive to taxes as you grow how are you, what kind of securities are you invested in? Using technology to boost after-tax returns, like our intelligent technology does, allows you to take more money home. And that's really what's important, and that's what we're focused on. We don't want just growth with no tax awareness. We want to be very, very sensitive to the overall.
So this year, diversify, look at private assets, focus on after-tax returns. Okay, further, what makes you guys different? Or what's your sort of hook, what's your selling point for investors?
So our selling point for, and we have to look at this through the lens of how we grow. We started farther in 2019. I came out of Goldman, where I was in wealth management, and what we saw was AI was coming, and that we could fundamentally operate in a different manner. We could be much more efficient, which means we could boost people and blend people and technology to create better outcomes for clients. And like I said, staying calm, staying invested actually takes a lot of emotional discipline. That's where advisors come in. The technology can handle the operations, and we can reach more people. We can create better experiences, more customized experiences. We can create better after-tax returns, for example, on technology. That's really what differentiates us. And from an investment perspective, our efficiency on the operational side is much, much larger than what you would see in a traditional wealth management firm.
Well, I was going to ask you about that. I mean, maybe you don't want to name your former employer by name, call them out, but like, do you feel like the traditional TradFi, traditional financial industry is missing that piece? I mean, everybody's talking about AI right now. Are they just not doing what you're suggesting?
Well, I think the big piece with AI is it is not a magic machine that you just turn on. You have to build all of the ecosystem around it. You have to have the people working with it, and you have to have all of the people oriented to it, and you have to have all the systems hooked in. So for example, we're actually seeing, what I think is depressed AI demand this year. If we look at my last year, and we've been living this life, we spent a lot of the year hooking our data into AI systems, making sure that it was secure, making sure that we weren't granting broad access to
sort of
things.
Testing it, in other words.
Testing it,
yeah.
Getting everything hooked in, getting everyone the mental model right, so that about how you use AI. And it's not that traditional firms can't do it. I have a lot of respect for my former employer, but it is much harder to do when you have been operating a business for decades and decades, right. And that's sort of the opportunity we saw. These are the moments when big financial firms are born.
Gotcha. Real quick, what's your AUM now, assets under management?
We're a little over $13 billion right now, and growing very, very quickly.
All right, thanks so much, Brad. Appreciate it. Nice to meet you. And that was FA Corner, brought to you by Capital Group. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages, we've got a rally today, although it's abating to some extent. The NASDAQ was earlier up more than 1%. Now it's up 0.75%. The S&P and the Dow, though, continue to rise by about 0.5%. Let's take a look, though, at what we've been watching this year. Honeywell, it's one of the worst performing stocks in the Dow Jones Industrial Average this year. Shares down more than 6% in 2025. So we're taking a closer look at the company as part of our Down Bad series. Joining me now is Amit Mehrotra, UBS Industrial Sector Head and Multi-Industry Analyst. Amit, so what happened to Honeywell this year? Obviously, there's a lot of structural changes at the company in terms of the one-time conglomerate becoming less conglomerated, I guess, so to speak. And most of the time when we see that happening, it's in order to unlock value. Why do we not see it play out exactly that way?
Well, good morning. Happy holidays, first and foremost. So yeah, on Honeywell, listen, I mean, this is a work in progress is the way I would characterize it. You know, keep in mind that the Honeywell stock price today does not reflect the spin-off of their advanced materials business, which is now Solstice. So that gives maybe $10 more to the stock price. But you're right. You're absolutely right. It's underperformed the broader market. Obviously, the broader market is being propelled by AI infrastructure spending. So I would say if you step back for a minute and look at the overall industrial complex, it's up about 17% this year, while Honeywell has lagged. But that XLI has been really reflected of the haves and have-nots. So Honeywell, it does not have a lot of AI and data center exposure. And so when you put them in that bucket, they actually haven't underperformed the other names in industrials when the top performers are like the GE Vernovas, GE Aerospace, the Howmets of the world that are either exposed to these structural end markets that are growing at a very fast pace. But the bottom line is, as I look over the next 12 to 18 months, the opportunity is very much for Honeywell. They're going to affect their spinoff of the aerospace business in the middle of this year. They're repricing some OE contracts that have been out of the money over the last several years. They have an automation business that part of that is growing very, very strongly. So I think there's going to be an education in the market as this company goes from a conglomerate to simplifies its story, and hopefully that translates to outperformance. But they've got to execute and they've got to deliver on that opportunity.
So it sounds like they're not necessarily chasing that AI build-out opportunity that the rest of the complex is, but you just think that the other businesses will be performing better independently than they were together.
Well, listen, there's plenty of examples of companies that simplify or spin off that ultimately translate to significant value creation. So, for example, when you look at the old United Technologies and what's come out of those businesses, when you look at Train Technologies coming out of Ingersoll Rand, when you look at GE Aerospace and Vernova coming out of GE, obviously these are different stories, and in any case, there's some stock-specific dynamics going on. But the bottom line is that when you emerge from a conglomerate into a standalone company with direct end market exposure, those management teams tend to be very focused and allocate capital more efficiently. And I think that would be the opportunity for Honeywell, but they've got to deliver. And so hopefully starting in the middle of 26 and beyond will be a new chapter for that company as they go down this simplification path.
Aerospace that part of the business has been doing better on a relative basis than most of the rest of the business. Do you expect that to continue going into next year? I mean, we know that sort of defense spending, for example, that has been holding up.
Well, so Honeywell's aerospace business is a $17-18 billion revenue business. It's a huge business, and they've got good exposure to commercial aftermarket, defense and space, as you mentioned, and then also commercial OE. I would say part of that OE business has been under earning because some of these longer dated contracts have been, the inflation has outpaced their ability to recoup that inflation. Over the next 18 months, that starts to turn as some of these contracts get reset. And so the bottom line is that growth has not been the issue for Honeywell's aerospace business. Margin expansion has been the issue. One is their starting point is quite high. This is a 25-26% margin business. So by no means is it a bad margin business, but they just haven't expanded it to the rate that they have because of this OE versus aftermarket mix being exacerbated by some of these OE contracts that are just underwater. And so net, I would think that this is the company that's going to be giving their 2026 guidance this time next month. I think they'll be in a position to talk about high single-digit growth in aerospace, margin expansion in aerospace, which has not been part of the story, and then they can continue to build on that in 27 as they reset some of these contracts. So I actually think the aerospace story is turning from average to maybe not so good from a bottom line perspective to actually a pretty interesting, compelling margin opportunity starting in 26.
Gotcha. And sorry, Amit, OE is their operational excellence business? Is that what
sorry. That's just my tech talk, so to speak. It's original equipment. So
original equipment, thank you.
Yeah, I apologize. This is new aircraft that are being delivered as opposed to servicing existing aircraft that are already in the air.
Okay, gotcha. OEM I'm used to with cars, but that was a new one for me in this context.
Sure.
I'm also curious. Okay, so you have a buy, for the viewer, you have a buy rating on Honeywell. You've got a $268 price target, 12-month price target, which you've laid out the rationale for that. I do want to turn to maybe some of the other industrial stocks that you think could outperform next year. Johnson Controls is at the top of your list. I know you have a bunch that you think could do well, but Johnson Controls in particular, what is the narrative and the theme around Johnson Controls?
So, I would say Johnson Controls, is a very old and company with a lot of heritage, and they've gone through a lot of change over the last 20 years, certainly in the last decade when they merged with Tyco about 10 years ago. And I think there's just been a lot of money that's been left on the table as those mergers have taken effect, meaning I think there's a lot of cost opportunity. There's a lot of integration that can happen that just didn't happen over the last decade. And I think they have the right leader in place. In fact, the CEO is relatively new. He joined on March 12th of this year. He came from Danaher. Danaher obviously has a very good track record of business integration and operations and execution. And so the bottom line is that Johnson Controls is a mid to high single digit growth company in our judgment at UBS. That's what we believe here. But there's also about $1 billion cost opportunity that we published and talked about that's 500 basis points of margin. So this is a $20 billion revenue company with about $1 billion of idiosyncratic cost opportunity based on our estimates, combined with a growth story. And so I think it really checks a lot of boxes, because usually in industrials, you don't see a lot of cost stories being married with growth stories. And with Johnson Controls, you have both the cost story and the growth story. Stock's up 45% this year after being up 45% last year. So by no means is this a cheap stock today. But the point that we're trying to make at UBS is that if you have some vision about what this company can earn in 27, 28, 29, JCI is a very cheap stock on those earnings numbers because of that outsized cost opportunity. So we would highly recommend our clients, and we do highly recommend our clients, put new money to work in a name like Johnson Controls because of those two dynamics on growth and costs.
And while I got you, I got to ask you about some of the other names you've alluded to, because they've also done quite well this year. You know, AG Vernova, Vertiv, I know is one of your picks, 3M. I mean, industrials have, by and large, there are some exceptions, but by and large, they've done pretty well this year, in part because of that AI build out. How much more run room do they have on the back of that theme in particular?
I think we're just getting started. The bottom line is that, you know, when the industrial economy turns from recession to growth, it doesn't happen for a month or two. It happens for about 3 years. We're still in an industrial recession, believe it or not. And what I would say is that, you know, when I think about the different pockets of exposure, so data center infrastructure build out, you know, between 25 and 27, so in the next 2 years, the spending of hyperscalers for infrastructure or data centers is going to grow by 60%, 30% just in 2026. So if anybody's calling the top on this, you know, last time I checked, bubbles don't burst when everybody's waiting around for them to burst. The bottom line is that is going to be highly accommodative for that theme that's been supportive of the economy. What I'm most interested in, what I think is most differentiated in what we're saying, is that the non-AI CapEx cycle, which has been an industrial recession, is starting to wake up from its long hibernation. We are seeing companies, whether it's Parker Hannifin, Dover, you know, all these old world industrial companies start to actually report organic growth and some acceleration. And I think that's a sign that the non-AI CapEx cycle that has been absolutely not accommodative is starting to be accommodative. And then when you layer on the fact that these companies have pricing power, some cost opportunity, you get to very, and let's not forget, interest rates are going down. We can all debate about, you know, how much they're going down and the magnitude of the decline, but we cannot debate about the direction of travel over the next 6 months. And so when you have AI CapEx accommodative, non-AI CapEx starting to be a little bit more accommodative, and then Fed cuts, those three are very important stools of the overall economy in the market, and they're both quite accommodative. So hopefully if you have me on a year from now, we'll be looking back and we'll still be showing an industrial economy in the XLI and the industrial equities that are up double digits after being up double digits this year. And then we could debate 27, but I think the next 12 months looks pretty good.
I love how fired up you are about it. I know in industrials, you don't always have these kinds of moments. So you got to grab it while you can, I suppose. Thank you so much. Appreciate it.
All right. Happy holidays. Thank you.
You too. Thanks. Coming up, much more markets action. Stay tuned. You're watching Market Catalysts. It has been a rocky couple of years for the nation's commercial real estate market, but signs are pointing to growth potentially in 2026. Joining us now on how investors can capitalize is Hassam Naji, Marcus & Millichap CEO, which is one of the largest commercial real estate brokerages in the country. Good to see you, Hassam. So, indeed, it's been a little bit of a rocky road here, and commercial real estate is a big category, right? We're talking about offices, we're talking about retail, we're talking about some other categories. What changes going into next year do you think that will sort of cause a more positive inflection?
Good morning. Thanks for having me on the program. It's great to be with you. The most important element going into 2026 is the effect of time. We've now had almost 3 years of a market disruption, and the first phase of these interruptions in capital flows and questions about valuation when interest rates are spiking as they were over the last several years is pricing, and how do you value real estate? And that first phase of a disruption is always kind of a deer in the headlights among sellers and buyers. So the market really experienced that shock in 2023. We saw a little bit of a recovery in 2024 and build on it to some extent in 25, although 25 was somewhat disappointing because of the Fed change in strategy going into the year was to be much more accommodative than the Fed turned out to be in 2025 because of tariffs and some other noise in the marketplace. Going into 2026, we've now had the time element of price adjustments. That's probably the most important element in commercial real estate as investors value alternative investments and yields. So with prices coming down pretty measurably in the last 2.5, 3 years in pretty much every property type, we now see a very big advantage to replacement cost. The cost of building new structures has been soaring, land costs, labor costs, and so on, and it's getting harder and harder to build new commercial real estate product of any type. So that measurement alone is bringing a lot of capital back into the market, number one. Number two, despite what the Fed is saying, we believe that the economic slowdown, especially with the job revisions that we saw a few months ago, will sort of force the Fed's hand to become more accommodative. So interest rates are most likely to go down than they are to go back up. And that's going to be a major catalyst for transactions as well. Commercial real estate is very dependent on the cost of capital and uses leverage quite a bit as an asset class.
So as I mentioned in the beginning, it's not a monolith, right? There's lots of different subcategories. So talk me through some of those categories. I imagine it's office that fell the most and has the most to gain, but tell me if I'm right about that, and what's the outlook for that part of it in particular?
You are absolutely right. The office sector was hit extremely hard in this last cycle, unexpectedly, of course, because of the pandemic and the after effect of remote work and then hybrid work. But the company mandates to bring people back into the office in the last 18 months has really worked. About a year ago, daily office attendance across the country was around 55 to 60% at best. And now it's sitting at about 80%, maybe even north of 80% compared to 2019, pre-pandemic levels. So it's improving for sure, but unlikely to go back to where it was pre-pandemic. I think the work environment of at least 1 or 2 days out of the office for most workers is here to stay. So demand will be permanently lowered, we believe. But the good news is that there's been very little new construction of office product for quite some time. But you're right, the values in that sector were hit the hardest, as you would expect, as was the loan performance, put a lot of pressure on banks. But as we're coming out of it for 2026, the most favored asset class, believe it or not, is retail. Because retail went through a significant restructuring because of e-commerce, and brick and mortar retail was under so much pressure for the better part of the last 20 years. A lot of shopping centers have been either modified or rebuilt or even converted entirely to other uses. So there has been a supply reduction in retail. And the consumer is back, of course, with experiential retail, foot traffic into restaurants, bars, and fitness and beauty-related kinds of reasons to go to a destination retail shopping center has increased dramatically, and it's doing very, very well. Multifamily apartments have always been very stable. Going into 2026, the price corrections in that sector make it very attractive. We're seeing lots of activity. But what's interesting, as you said, in commercial real estate, you have self-storage properties, you have mobile home parks, you have seniors housing facilities. It's a really diverse way to invest in real estate, and the tax package that passed in 2025 saved or added to a lot of helpful provisions for commercial real estate investing, which is another reason we're seeing capital come back into the market.
Within retail, just to dig into that one a little bit, Obviously, retail goes through different sort of cycles of what's popular. You know, we went through the mall dominance of the 80s into the 90s. Then we went sort of big box shopping centers. With this rationalization that you talked about that we've seen over the past few years with a lot of closures, what's the emerging trend out of that in terms of the new hot retail format?
You know, open air centers and power centers with discount shopping in a Costco destination type of value retail or TJ Maxx, those are doing extremely well. But broadly speaking, what's happened with retailers have become so much more intelligent about maximization of the use of space in that they're having smaller footprints, less cost carry for inventory in the store, and more of a customer experience these days. You know, with online ordering and all that, the need to store goods on site has diminished tremendously. So the focus is on the customer experience and reasons to attract foot traffic. This is where restaurants, bars, fitness, and beauty come in, as the population basically seeks those kinds of experiences. Being able to shop while you're out there is an important factor. Interestingly enough, as the office market was suffering post-pandemic, daily traffic into retail was increasing because everyone who was working virtually wanted to get out of the house and needed a Starbucks or an internet cafe. And that brought in a lot of daytime traffic, which would have been completely unexpected. This is one of the points about commercial real estate. It's always pivoting and shifting to whatever's happening around us. But I would say that the use of space and efficiency in inventory management is probably the most important aspect of retail. We're seeing a lot of digital brands that were never in the brick and mortar business now open shops and expand into brick and mortar retail to have more of that omni-channel exposure to customers.
And Hassam, one other, speaking of the adaptability within real estate, we seem to be seeing quite a trend of office to residential conversions, office to apartment conversions. Part of that a factor of the weak office market, I imagine, over the past couple of years. And the numbers are pretty dramatic. I saw one estimate from Rent Cafe that there are almost 80,000 unit conversions in the pipeline, which seems like a lot. Have you seen that in your career before? I know there have been sort of these trends before, but how is this one different, and what should we be paying attention to?
There's definitely more and more examples of older, obsolete office buildings that have a really hard time competing with newer properties being converted to residential. But it's very limited. Actually, the numbers that you just quoted are large in volume, but as a percent of the total universe of residential housing for rent, or even if you look at it on the flip side, the office inventory, it's a very, very small percentage because it's extremely expensive and difficult to do so. When retail was hit really hard, the reimagination of a shopping center or even a complete reuse of a shopping center is a lot easier and cheaper to bring about versus a mid-rise or a high-rise office building in an urban market, which is where most of the pain has been located. I should mention that the bifurcation of office product, Class A, which is essentially newer, more modern properties built in the last 15 or 20 years, has done much better than older, more Class B, Class C office buildings, especially in urban markets. Suburban office has actually performed fairly well in this downturn.
Hassam, good to see you. Happy holidays. Thanks a lot for joining us.
Thanks for having me. Happy holidays to you.
Thanks. Much more market action coming up. You are watching Market Catalysts. Now time for some of today's trending tickers. We are watching Carnival, Lamb Weston, and Conagra. First up, Carnival. The cruise operator reported fourth quarter earnings that topped estimates. Carnival also gave a better than expected profit outlook for next year and reinstated dividend payments, those shares up nearly 10%. The results are lifting shares of other cruise operators too, and they offer an optimistic sign on discretionary consumer spending. Next is Lamb Weston. Shares of the frozen potato company are plunging after it maintained its full year guidance. Investors clearly not happy with that outlook because the second quarter expectations did beat guidance. Lamb Weston did note in the release that price mix, which really means how it sets its pricing, declined 8% in North America amid ongoing support of customers. Shares are now at their lowest since 2020. but it still has 6 buys, 7 holds, and no sells on Wall Street. Finally, sticking with food, Conagra Brands, the owner of Duncan Hines and Slim Jim, saw second quarter organic sales decline by more than analysts expected. The company is suffering from consumers who are increasingly trading down and seeking discounts. Cost inflation also continues to pressure its profitability, and Conagra particularly exposed to tariffs through its use of steel and aluminum in packaging. 2025 marked a turning point for the auto industry, with the big three automakers, Ford, GM, and Stellantis, all backing away from their lofty electric vehicle ambitions. Senior autos reporter Pras Subramanian is here now with a closer look at the pivot. So let's take them one by one. And let's take Ford first, which just gave us more information recently about their pivot.
Right. And, we assumed things would be changing at the end of 2023, change in new administration. So there was a preview of things to come, and Ford basically a year later now sort of revealed their big pivot, a $19.5 billion charge to the EV business. I mean, that's a huge number, one of the biggest that I think we've ever seen from a write-down from both a cash and special items charges there. So, but basically what they're going to do, they're going to convert to more hybrids, build more gas-powered cars, fewer EVs. They killed off the F-150 Lightning EV pickup, which was such a big deal when it came out in 2022, right? So they're still going to make particularly small to mid-size EVs. I think that's the sweet spot for what people will need to what they want, what the market is underserving right now. So that's their plan. But the downside is, what happens if you got to pivot again? There's a lot of talk that the EVs might make a comeback, right? Because technology is getting better charging, more chargers. That's the problem for Ford, is they're taking such a swing back in the other direction. Can they still repivot again?
Yeah, I mean, that's something Itai McKellar, who I talked to from TD Cowen, he was on the show yesterday, and he is optimistic for EVs going into next year. He said because of price and innovation that we will still see demand. We'll see. What about General Motors?
I mean, I actually quoted Itai in my piece talking about GM being that they're better at execution, and they're sort of a broader portfolio of EVs. So let's talk about them. Yes, they do have a broader portfolio of EVs. They have the cheaper EVs from the Equinox all the way up to $100,000 Sierra EV truck, right? So they have the whole sort of market there for EVs. Now, obviously, the higher end of the market is very challenged. People don't want to spend that kind of money. So they took a charge on that, $1.6 billion last quarter, to try to address those EV pivots and things like that, right? But they indicate there's more to come. There's more charges to come. Maybe not 19.5, but more to come. But people like Itai McKellar talk about how when that tide does turn, GM, which is known as a better, more efficient operator, they actually have, their EVs are a bit more efficient from a cost basis. They can probably capitalize on that and get back into the game, the EV game, when and if the market turns. Okay, and Stellantis, how do they fit into all of this? Sorry, I don't mean to laugh, but Stellantis has been sort of fits and starts. They were very late to the game. Their prior CEO, Carlos Tavares, said, "I don't believe the EV sort of roadmap is going to happen this fast." He was let go, and he may have been right, because it was now that Stellantis' EVs are coming out, there's no one to buy them. In fact, their Charger sports car that was going to be all EV only is now pivoting to gas and electric. They're also, the Wagoneer S is the only other EV they have, and it's not really selling that well. It's a Jeep vehicle. And then they're going to bring back the old Hemi V8 to the sports cars and the Ram trucks, and they got rid of the Ram EV truck. So it's more the same with Stellantis and the other automakers here, but I guess the problem is that they waited so long, and they finally came out with the vehicles, and then now they're not hitting the mark. But the other thing is that they indicated they're going to take charges for the EV business. They have not said so. It's probably going to come out in their second half results, so we'll be watching that. But there's also the Euro factor for them. They're very European based, right? And so they have a lot of markets in Europe that do want EVs, and they're able to make smaller EVs with their partnership. So that's an interesting thing for them, because they have two very different markets, and they have to sort of cater to both.
Well, of course, in Europe, though, they're competing with Chinese EVs, are they not? And those are pretty competitive. You know, it's so interesting to me. It seems like they've really pivoted from like transitioning to EVs to let's offer you a menu, right? And you'll have gasoline-powered cars, you'll have hybrids, you'll have EVs, and sort of let the consumer make the decision about what they want. But I guess the issue is if consumers really don't want one of those.
Well, I think it sounds easier said than done, right? Well, give them whatever they want, but that's billions of dollars in investment. You can't, invest in like making 10,000 EVs. It needs to be 1 million, right, to make it make sense from an economics point of view. So that's the really big hard place that they find themselves right now, is as they pivot to spending more on building gas-powered factories for gas-powered cars, what happens when that changes? That's the big question.
Yes, and will it change whoever the next administration, for example?
That's another risk,
ends up being when you're making these long-term big spending plans and you have that kind of uncertainty.
Right, exactly.
Not to mention tariffs. Gosh, we didn't even talk about those. We could do this all day.
I didn't want to get into that. So.
All right, fair enough. A little more focused. Thanks, Press. Coming up, a look at the future of Berkshire Hathaway without Warren Buffett at the helm. Hear from one shareholder about the bull and bear case for that company. That's next. Berkshire Hathaway has long been seen as the ultimate buy and hold stock, but now investors are asking what the next chapter looks like without Warren Buffett at the helm. Yahoo Finance's Josh Lipton spoke to Mel Casey, senior portfolio manager at FBB Capital Partners, about the bull and bear case for Berkshire in 2026.
Mel, it is good to see you. So let's have a bull-bear debate here on Berkshire, Mel. And just full disclosure, you are a shareholder. We'll start with the bull case, though, because you say here, Mel, this is interesting. You say Berkshire has an all-weather quality, is how you put it. What do you mean by that, Mel? Explain that.
Well, thank you for having me on, Josh. I think if you look at the at Berkshire Hathaway, it's primarily an insurance business, but really it's large enough that it's a conglomerate. It's involved in many different places. So there's kind of a cyclicality and a counter-cyclicality within that portfolio. So you could almost even think of it as an alternative to a lower risk alternative to owning the broader market. And you're going to find some of the businesses like the insurance are counter-cyclical, but then other parts like the railroad are going to be more sensitive to the economy.
How would you characterize valuation here, Mel?
So in a year of pretty high valuations for U.S. large cap stocks, I think Berkshire's still pretty reasonably valued. If you look at the estimates for next year, it looks a little closer to the overall market on a price to earnings ratio. They prefer book value. I think that's fair because there's so many different businesses here. On book value, it's around about 1.5 times. That's historically a little bit higher than it had been before. Also, shareholders who pay attention know that Warren Buffett advocates repurchasing stock at 1.2. So it's a little bit above his level. But when you look at some of the other companies that make up the market, it's certainly reasonable, if a little bit higher than it has been in recent past.
And Mel, post Buffett, how does the bench look at Berkshire? Would you say that falls into the bullish column?
Cautiously bullish. We've had a couple of changes in that bench recently. That was a little surprising, I think, to investors. Todd Combs' departure in particular. Been there a couple of decades. You would have thought that this was the exact moment that he was waiting for, but there's been a change there, and that's fine. The bench is still deep. Greg and Ajay, these are very, very seasoned folk. It's reasonable to think that a lot of the values that have brought the company to this point will continue to be in place. We wouldn't expect major changes. Wouldn't be holding out for a dividend, or I wouldn't be expecting major swings and aggressive allocations of capital. But there's definitely a culture in place that I think the bench will probably continue to keep in there.
So we walked through the bull case. Let's talk about the bear case, Mel. Let's outline that one. One concern you have, the risk of losing the Buffett premium. Explain that.
Yeah, there's no question. There's no investor out there. There's no CEO or investor spoken about as much, quoted as often. There's so many books out there. I mean, there's an iconic investor. We lost Charlie not that long ago, Charlie Munger. Warren Buffett is stepping down. And so, and anyone who's been to the annual event in Omaha will testify that it feels different. It's not a regular company meeting. So is there some premium there? You could argue that some of that's been coming out over the course of the year. It's performed about 2/3 of the overall market performance this year. Some of that is related to some of the underlying business trends, which we can get into in a second. But there's definitely a caution out there that some of the core investors are investors in Buffett rather than in the actual fundamentals of the company itself.
You also say here, Mel, Berkshire's sheer size makes outsized returns extremely difficult. Fair enough. If that's true, Mel, what do you think returns are likely to look like then in the quarters, years ahead?
Well, I think instead of home runs, we're talking about singles and doubles, and I think we should be okay with that. This is a large cap company sitting on a pile of cash, and discipline is really important here. So, whether it comes to, whether it's the investment book or it's actually acquiring companies outright, they've always been happy to sit on cash, and that cash pile has grown. And so it's really hard to move the needle. And when you get to this size, like the very dynamics that got them to this point, it's going to be hard to replicate that in the future just because of the size. So I think that the discipline and the continued focus on discipline, again, what do they say? Waiting for that fat pitch. Well, waiting for half decent pitches is okay, but as long as that discipline remains in place, I think more reasonable or more market-like returns going forward, more broad market returns going forward seem reasonable.
You mentioned that cash hoard, Mel. What, as a shareholder, would you like to see them do with that?
Well, I think I think a dividend would be welcome because it would broaden the number of investors who can own it. It would also mean there's an awful lot of funds that would automatically, there'd be a lot of buying automatically into a lot of income funds where there's a rule there that you have to pay a dividend no matter how small. Apple discovered the benefit of that many, many years ago. So some kind of dividend makes sense. I just wouldn't, wouldn't be holding our breath on that one. Ultimately, I think waiting for a better entry point to add to stock, repurchasing shares, that's also very valuable for shareholders. That does there's tremendous return for shareholders by being patient, disciplined, but then at the right time aggressive in repurchasing stock. So we're comfortable with that approach.
You've laid it out very well, Mel. I'm curious. So who is the investor, Mel, who should be putting new money to work in Berkshire, as you imagine it?
Yeah. So as you mentioned earlier, our clients are shareholders. I'm a shareholder personally. This is for the long-term investor, and particularly investors who find themselves kind of heavily weighted towards the high valuations, the market leadership, anything to do with technology or AI. You're getting a lot of diversification here in this name. Now, we like to think we can diversify for clients with different names, but there's a lot of diversification here. There's a little bit more of a value bent to this name than some of the other large companies in the market. So while near term, you may have some uncertainty here and there, long-term investors have been rewarded up to now, and even if it's a little bit more modest going forward compared to the past, we believe long-term investors will be rewarded for holding this name.
Mel, you broke it all down very clearly and simply. Thank you, sir.
Thank you.
Coming up, how the K-shaped economy is showing up in travel and what that means for airline and hotel prices next year. A record 52.6 million Americans are set to travel by plane over the course of the rest of 2025, an increase of about 1% from a year earlier. But according to my next guest, the affordability crisis could start weighing on the travel economy going into next year. We're joined now by Katie Nastro, Going travel expert. Katie, thanks for being here. So we've been talking a lot about the K-shaped economy, the affordability crisis. Are we starting to see that show up at all in how people are traveling, the choices they're making?
Yeah, look, affordability is becoming really the question in the story of travel. You know, as the market is splitting into high-income travelers continuing to travel and look towards more premium experiences, and then lower-income travelers really being selective. You know, we're actually seeing a pullback in terms of the amount of anticipated trips that the average traveler is looking to take in 2026, specifically internationally, and that's the first time since 2023. You know, premium cabins are booming. Just premium investment by airlines are really booming, while the average traveler is feeling a little bit squeezed. You know, economic uncertainty is one of the three most or highest data points that we found over at Going. That is why we're seeing sort of that potential pullback for 2026. But what is really interesting here is when you isolate airfare only, looking at inflation-adjusted airfare over 2025, June was the second cheapest month ever recorded. At the basic level, base airfares are some of the most affordable that it's ever been in sort of the history of flying. And so, even with this K-shaped economy where airlines are definitely heavily investing in that premium traveler, it is still affordable for that average traveler to go out and explore the world.
But are a lot of people, opting for, say, road trips, for example, instead of taking those flights?
Yeah, and we definitely have seen an uptick or a moderate uptick, I should say, in road travel across 2025. Looking specifically at Thanksgiving, which is an interesting time period because coming off of that government shutdown, that lengthy government shutdown, that really had a ripple effect across air travel. There was a little bit of shyness in terms of looking to fly during that time period in the worry that there was ripple effects even still. But, those, when you're looking at holidays specifically, Thanksgiving, the winter holidays, those are driving holidays. Majority of travelers are going to be driving during these time periods, which I think people tend to forget because air travel is so much more accessible and fares have come down and more people year after year after year do travel by plane. So, majority of 2025 has been a mix, and there certainly has been a portion of people that have opted to take road trips versus flying because of economic uncertainty and because they want to look towards a more quote-unquote affordable trip and an easier trip. And, gas prices, some of the lowest they've been in years, which can definitely play a factor in your overall travel costs.
So people trying to save money, but on the other end, we know there are people who are still willing to spend money, right, on this stuff. What kind of trends are we seeing then on that upper income end of the spectrum?
Yeah, when it comes to that premium travel, so to speak, we're actually seeing that majority of our travelers, according to our Going State of Travel, are looking to spend up when they are taking these sort of big moment trips, mostly on accommodations. And then the second highest category would be on the creature comforts of upgraded flights. So thinking, extra legroom, business class, premium cabins. Premium economy, for example, is the fastest growing sector in terms of the seat type that we're seeing more travelers are looking to spend into. And it's really sort of a great entry level for anyone that is sort of maybe a little bit more flush with cash. They want to have a more comfortable experience, but those business class tickets are sort of beyond their threshold for spending. And premium economy is definitely that sort of segue, but it is a segue that then wants you to continue to want to travel, quote unquote, luxuriously. So it's, right. The airlines love it. It's one of their best performing sectors. And we can definitely see more people looking towards that as sort of that entry-level model or entry-level ticket for luxury travel, so to speak, in plane travel.
Right. And Katie, one other thing I wanted to ask you about is like social media-driven travel, right? People are looking at influencers. They're you see these trends take hold on TikTok or wherever, and then people that becomes the next hot spot for people to travel to. What are sort of the pros and cons of that whole phenomenon?
Oh gosh, yeah, the trendification of travel. This is really an area that we've seen growing specifically due to social media. Interestingly enough, though, friends and family are still the number one source for the average traveler when it comes to recommendations. But when you're looking at younger demographics, an overwhelming amount, over 50% of our travelers surveyed during our State of Travel stated that they look towards social media as their planning, their inspiration for making their next getaway. And so that's leading to, again, that trendification in travel, destinations seeing an explosion of interest in searches by way of travelers. You look at destinations like Sicily due to the White Lotus, et cetera, et cetera. But on the ground costs can then skyrocket. Yes, you're getting airlines investing in more routes to meet that demand from that trendification, but on the ground costs can skyrocket, upwards 30, 40, 50%. And that really has a toll on the local, not just the local economy, but it has a toll on locals in itself. That day-to-day sort of minutia can really be disrupted. And so these destinations that are bucket list are becoming sort of these it's an unfortunate ripple effect of social media having such an impact on travel.
Right, and we've definitely seen in some of those places some backlash from those local residents that you mentioned. Katie, thanks so much. Happy holidays and happy travels to you if you're going anywhere.
Yeah. Yes, thanks so much. Happy travels to all.
Thanks. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We've got more Yahoo Finance coming your way next.